history of lending is such a fun story. We always said at Cabbage, we were in the world's second oldest profession. So lending has been around forever in many different forms. Historically, it was a very personal transaction. It was you knew the guy who had the goats and you had the wheat. And so maybe you didn't have enough goats. And so the guy would loan them to you until you had enough wheat to pay for them. So I think lending happened way back in time.
Lending has been around for thousands of years, and the context is always based on a shortfall. In the past, it might have been that you needed a loan until your crops came in. Or nowadays, it could be you want to buy a car, but don't have the money up front. Lending has always been part of banking and money exchange. The first form of bankers, the village goldsmiths, were the first to start lending out the gold in their stores, creating rudimentary forms of liquidity.
After a while, the goldsmiths sort of sat there and they thought, maybe I can use some of that gold. Although it isn't mine at the moment, and it's kind of sitting there gathering dust, maybe I can lend it out. And as long as I get that money back from the person I've lent it to, before the person who owns it comes to ask for it, everything's good. And what actually happened often was that the person who got lent the gold would then go and spend it somewhere, who would then go and take that gold and put it back into the original goldsmith. And the goldsmith would issue a receipt for it. So you've got this interesting case now where you might have £120 worth of gold receipts out there, but only £100 worth of gold actually in the goldsmith. So actually the amount of gold that's sitting in the goldsmith is only a fraction of the amount of paper receipts. And obviously the goldsmith can then use this gold that's now sitting there to potentially lend out again and again and again. And this is effectively what happens nowadays in the banking industry. There is a fractional amount of gold or underlying assets that are stored, and the banks can effectively repeatedly lend and lend and lend. So fractional banking fundamentally underpins everything we do.
In the early days, goldsmiths and banks lent and lent until they went bust. Nowadays, regulators have to put in strict laws around how much banks can and can't lend to stop that happening. But what's in it for banks? Why do banks lend?
In a simplistic way, the view is that if you have deposits, then you probably pay interest on those deposits, therefore it costs you money. If you do lending, then you get interest on the money that you're lending, and therefore it makes you money. So the more you lend, the more it makes money, the less that you keep deposits, the less cost overhead you have. The difficulty with that is that if you lose track of the complex network of money that you've created, then that can implode like a deck of cards overnight.
There is a high risk to any bank or lender if they cannot keep track of how much money they are lending. This could lead to potential collapse. It is vital to have a solid record of money coming in and out. This is called a ledger. A ledger from 3000 BC may have looked something like this. They divided the tablet into rows and columns. Within each cell, they drew a picture of each item and made puncture holes indicating the amount. This ledger system evolved over time from clay to paper, and now more recently into digital alternatives. But the principles remain the same.
So if you look at the evolution of the ledger, I would argue that a lot of progress has really been how do you do the previous form of ledger taking more efficiently and more productively, rather than how do you rethink the form of ledger. So I think it's all been more evolutionary rather than revolutionary.
But what about the other side of the equation? How do you ensure the people you lend to can pay it back? There is always going to be a risk that someone cannot repay.
Basically, in the old days, because goldsmiths were so susceptible to losses, credit losses, they really only lent money to the people they properly trusted. That's why things like character and having good collateral, clearly you actually want to lend to people who have assets to be able to pay back in some way, shape or form.
The gist would be in Medici, Italy, is that banks would lend to those they thought were good enough for the money. What's the cut of the cloth? What does the person look like? What guarantees can they show me and provide me? Can they leave me with some form of collateral that I'll keep if they don't repay? Obviously, There's risk within that. And again, if you look at history, I think it's King Edward couldn't pay back the money to the Medicis and just said, sorry. And a lot of banks went bust in Italy.
Until 20 years ago, underwriting decisions were made because loan officers sat in banks and they read information about a person or about a business, and they decided based on some criteria that were provided by their institution whether or not somebody was eligible. And the thing is, humans are really bad at that. And humans are bad at that because we have these biases that are built in. So let's say I'm a loan officer and I'm sitting across the table from a guy named Josh, and he's applying for a loan. But my ex-boyfriend's name was Josh, and he just broke up with me and he was cheating on me. I hate all Joshes going forward. I'm not going to like this Josh guy across the table. No matter how hard I try to be unbiased, I'm not going to like him. And I think that's the challenge that you have.
If you look at what happened through the 90s and 2000s, you had sort of credit decisioning models developed on a central basis, rolled out through branches, which fundamentally meant that you had what we like to say as a computer says no approach to lending. And as a function of that, the number of people who can get lent to, you sort of narrowed the fairway pretty dramatically. And then I would argue in certain segments over the last decade, because of the activity in the fintech space and the like, you've had a re-expansion of actually the universe of individuals and companies which get lent to. But I would still say there's a long, long way to go to move to an environment which was closer to the one where you had that community-based lending based on really the fundamentals of a business rather than a computer says no type approach.
Modern credit scoring opened up a lot of opportunities for many who would not previously have had access to credit, but it is not without some bias. Additionally, if credit scoring is not done with the correct due diligence and bad credit scores get written off and/or sold on, this leads to problems.
I think the problem with modern banking is that whereas in the past, the debt sat with the bank and the bank held that debt for a long, long time. And so actually if that debt didn't pay off, then the bank was liable for the whole lot. What's increasingly happened is that actually the banks and the people who offer credit can effectively sell that debt on, so securitization and things like that. So you look at things like the great financial crisis of 2010 and the housing failure in the US and so on and so forth, the subprime mortgages. These were people who weren't good for the money, ultimately, but they were lent it because the banks who originally did the initial lending knew they could package those debts up and sell them to somebody else. So if the mortgages weren't paid for, it was on someone else's book. They didn't really care so much for those loans.
In the case of the subprime mortgages that kicked off the most recent financial crisis, once the banks started to realise that these loans weren't actually as highly rated as they were seen to be on paper, and they weren't going to be repaid, they were in big trouble. With the low equity they had held in the banks backing up all the credit liquidity in the system, the last thing they needed was people coming to collect their money.
So if you look at what happened in 2008, you did have certain institutions which actually where the wider public had lost confidence, and as a function of that, there were queues outside banks, and queues outside banks in papers leads to increased queues, right? Because everyone views the fact that the institution may not survive, and therefore they want to get their savings out of it. So given those dynamics, again, when you look from a regulatory perspective, that's why liquidity is such a big topic. The amount of equity that institutions had to hold pre-financial crisis and post-financial crisis totally changed. So that shock absorption capacity has increased very materially. So that's one area. The other area is conduct, making sure that you're only lending to people who fundamentally can afford to actually have those types of obligations and service those obligations. So are you being a responsible lender and the like? So I think that there's been a number of different areas from a regulatory perspective which have helped the industry actually adjust post-financial crisis.
In today's digital banking landscape, with lending regulations tighter than ever and a robust credit scoring system, what does the future of lending look like?
I think that when you look at sort of commercial lending and corporate lending, it's still being done in a very similar manner to the way it was done a decade or maybe even 2 decades ago. Because if you think about it, the type of experience as a consumer we all get today from a financial services provider is totally different to what we got, again, a decade ago. But those same individuals, as soon as they go into their corporate persona, effectively end up with a heavily manual and heavily traditional interaction style, which I think necessarily has to evolve. That's not to say that the consumer and micro SMB space won't continue to evolve. I think it absolutely will.
Customers, whether they're consumers or small businesses, really need to understand what they're getting, and they need to see it in comparison to the other products that they may use. The companies that can win can actually take on the ownership of that education and do it in a way that feels fair and comfortable and easy to understand for their customers. So if you look forward in financial education, I think you're going to see financial institutions and fintechs deliver that education in a new way that makes customers want to work with them more than they might have wanted to work with another institution. I think it's a huge opportunity for growth and for acquiring customers.